Tesla is the hottest stock right now, currently trading at $1,513 per share, which is near its all-time closing high. Tesla closed 2019 at $418, meaning it's up year to date 262%. This is phenomenal growth during normal times, but to have achieved it during the coronavirus pandemic is nothing short of astonishing.
However, this is in the past. If you weren't invested in Tesla during this time, then it is largely irrelevant, unless of course you have a time machine. As investors, we are only interested in future gains and the risk involved. And right now, Tesla is looking very risky. We hear a lot of investing noobs banging the drum about how awesome Tesla is as a company and how their technology is going to change the world.
They might be right, but what these people don't seem to comprehend is that it is already priced into the value of its share price. And right now it seems that Tesla is all potential that is yet to be achieved. There will always be another hot stock in the future, so there's no need to worry about missing the bus, as another one will be along shortly.
Don't get us wrong, Tesla is a fantastic company and has been a fantastic investment up until now. In this video, we'll be looking at why Tesla is so awesome, but nevertheless, why we won't be investing right now. Let's check it out.
Welcome to Unshackled.com, the investment and finance channel and website that sets you and your finances free.
That was Andy and I'm Ben, and if you like what we say, hit the like button and click subscribe.
Whether you want to invest in Tesla or thousands of other US stocks, then the Stake Investing app might be exactly what you're looking for. Stake are sponsoring this video, so we want to give a special shout out to them.
Stake offers unlimited commission-free trading with trades executed in real time, and it is of course FCA regulated and has straightforward no-nonsense pricing. Better still, Stake has fractional investing, so stocks like Amazon and Tesla can be bought in any dollar amount.
And for a limited time, Stake are giving away a free US stock worth up to $100 when you sign up via our link. We'll put the link to the office page in the description below, so be sure to check that out. Now let's get into the video. What exactly do Tesla do? Tesla is an electric vehicle and clean energy company based in the US. Its main products include the Model S, the Model 3, Model X, Model Y cars and battery energy storage. It also produces solar panels.
Tesla's global vehicle sales increased 50% from 245,000 units in 2018 to 368,000 units in 2019. In 2020, the company surpassed the 1 million mark of electric cars produced.
What they do not have is a space program. Someone commented on a previous video of ours that Tesla's car business was a sideshow and that its Mars program was going to be a cash machine.
However, SpaceX is a completely separate business that is privately and majority owned by Elon Musk. Just because Elon is the CEO and largest shareholder of Tesla does not mean they are part of the same group. It goes without saying that you need to know what you're investing in.
Why Tesla is awesome. Unlike traditional car makers, Tesla do not use franchise dealerships to sell to the end customer. It owns its own sales channels, which gives customers a better buying experience.
Tesla's production strategy includes a high degree of vertical integration. This is rare in the automotive industry, where companies typically outsource 80% of components to suppliers. This gives Tesla a greater degree of control over its vehicles and in theory can improve quality and drive down costs.
Tesla's vehicles have fewer parts than their internal combustion competitors. This simplicity dramatically reduces the consumer's total cost of ownership and in theory makes Tesla's vehicles more reliable.
Will Tesla ever dominate the car industry? Just the other week, Tesla's shares hit an intraday high of $1,790. That valued the company at $320 billion. Not bad for a company that was spooked by bankruptcy concerns little more than a year ago.
That puts it at 50% more valuable than Toyota, and according to the Investors Chronicle, more than the collective sum of the next three largest automakers in the world, Toyota, Volkswagen and Honda. In our opinion, Tesla looks a lot like a bubble based on that statistic. Toyota and Volkswagen each produce over 10 million vehicles every year, 10 times the 1 million that Tesla has ever produced in its entire history.
In fairness to Tesla, it's a much younger company and you have to start somewhere. But how likely is it that people's car purchasing habits are going to shift at a pace that will allow Tesla to rapidly grab market share? Tesla cars are extremely expensive. To become a major player, they will need to sell cars that large numbers of people can afford.
Way back in 2006, Elon said, Almost any new technology initially has high unit costs before it can be optimised, and this is no less true for electric cars. The strategy of Tesla is to enter at the high end of the market where customers are prepared to pay a premium and then drive down market as fast as possible to higher unit volume and lower prices with each successive model.
Elon may have said that, but this image taken straight from a Tesla website today would suggest they are still targeting the upper end of the market. There's not too many houses that look like that in my neighbourhood.
The cheapest car is the Model 3, but it's not exactly affordable, starting at £43,000 before adding options and climbing rapidly for better variants. The Model X starts at £90,000. Last time we checked, the world is entering a global recession where luxury purchases are not going to be a priority in most people's household budgets.
Tesla is overpriced. Tesla has only just made, for the first time, 4 quarters of consecutive profit. But they have yet to make a profit in any full financial year. Let that sink in for a minute. They are being valued at close to $300 billion, and yet they have never made an annual profit. Yes, Elon, wow indeed. They are expected to become profitable this year, but even a company making a few $1 billion a year in profit should not be valued at $300 billion.
With negative earnings, that meant it didn't even have a PE ratio until its earnings report last week. A PE ratio is the price to earnings. It's the amount of money that an investor is prepared to spend for every dollar the business earns. The S&P 500 has a PE ratio of 23, which is historically high by the way. This means that investors are willing to pay $23 for every $1 of earnings. As it stands right now, investors in Tesla are prepared to pay money for negative earnings or at best barely any profit. This is obviously because these investors believe that Tesla would generate supercharged earnings growth. Or there's a lot of investors riding a speculative wave.
At this moment, we both feel that Tesla is massively overpriced, but we wouldn't be surprised if the share price continues to climb before the market acknowledges this. We're okay if we miss out on these gains because they are fueled by pure speculation.
It's impossible to know when to sell when growth is driven by speculation. The normal time to sell is when a share price is above its intrinsic value or true value, which with a share price at over $1,500 was probably a long time ago.
Elon Musk himself thinks that this stock is too hot. At the start of May, with the stock at about $780, he sparked a 12% sell-off by tweeting, "Tesla stock price is too high in my opinion." Straight from a horse's mouth. And the price is now double from when he said this.
One day, Tesla may indeed be worth this valuation, but not quite yet. And we bet there will be a better buying opportunity in the future to get Tesla stock at a cheaper price. This reminds us of the dot-com bubble, when investors were adamant that the internet would change the game. They were half right, but almost 2 decades out timing-wise.
Be fearful when others are greedy, and greedy when others are fearful. One thing that scares us is when retail investors, that's normal people, start pouring their money into something. According to the Financial Times, the number of Robinhood users holding Tesla shot up to about 450,000. These investors are hardly known for their astute analysis. If they're being greedy, alarm bells should be ringing.
BP's $1 billion bet. If Tesla and electric cars are going to change the world as we know it, then why are oil companies still valued so highly? BP has announced a new joint venture and have taken a $1 billion position and a 49% stake with Indian company Reliance. This is a bet that petrol stations will stay relevant for a long time to come.
Competitors. We don't know enough about Tesla's technology to know how game-changing it is, but we do know there are enormous volumes of competition. Tesla may have the first move advantage in the electric vehicle space, but let's not be ignorant of the fact that all the other major car makers are also developing their own technology. For those of you too young to remember, including us, Betamax was superior to VHS, but VHS won the videotape war. Betamax drew the first blood by launching a year earlier, but the cost proved too prohibitive.
In the real world, competitors will and most likely have already been reverse engineering Tesla's products to learn their secrets and replicate them, being careful to avoid patent infringements. Apple invented the App Store, but it didn't stop Google from creating their own version.
Question of the day, will you be investing in Tesla or do you feel it's too expensive right now? Let us know in the comments below.
Thanks for watching. On this channel we talk about personal finance, investing and all things money. And if you want to see more great content, please click the subscribe button below.
This is MoneyUnshackled.com. See you next time.